Good morning. As Doctor said, I have two sons. One's a junior in high school, and one is a senior in college, a business student at Mary Washington. He plays on the lacrosse program, and if there's any lacrosse players in here, your former coach is our coach now down at Mary Washington, so thank you. I asked him for some advice as far as speaking to the business students and what you would want to hear. And he goes, well, first of all, don't be boring, so I'll try not to be. I also brought chocolate, so please pass it around, and if you have peanut allergies, pass it along. So I'm going to do a little background. As Doctor said, I'm going to talk about Orrstown Bank, try not to bore you, and then talk about the banking industry in the 21st century, because so much has changed since the turn of this century. As you mentioned, I went to SHIP, and BS stands for Bachelor of Science. Just, when you're in business, it stands for other things too. Went to Penn State and did that at night while I was working. I'll tell you that was probably more beneficial to me because it was local. I was working for a local company, and I made a lot of connections in the marketplace. Folks that I still do business with today, and that was when I was there. That was 20 years ago. I started my career with Keystone Financial with Pennsylvania National Bank, and which was eventually bought by M&T, and I left there in 2006 and went to First National Bank of PA, which was a Western PA-based bank, and had come into the marketplace buying a much smaller bank. So I went over there for an opportunity, and then 2 years ago, I came to Orrstown Bank. What's interesting about that is that 2 years ago, there was a lot of turmoil in the marketplace, and bankers were moving all over, frankly, with a lot of the M&A activity in the banking industry, specifically in South Central PA. When I joined Keystone Financial, it kind of dawned on me that these numbers and how much they've grown. When I joined Keystone in 1990, it was $6 billion in assets. Banks are measured generally in asset size versus revenue size. So $6 billion in assets. When M&T bought Keystone, it was $29 billion. Today, they're $123 billion, which allows them to put name on the Raven Stadium and so forth. When I joined FNB in 2006, they were $6 billion in assets, and today they're $31 billion. And then joined Orrstown 2 years ago. The bank was 1.3, and now it's 20% growth in 2 years. Interesting, if I had kept a coffee mug and business card from every name that we worked under, I could supply a diner. Some of that had to do with banks that we merged in, and we relogoed. Some had to do with, in one case, M&T was the one that had purchased Keystone Financial. So I've been on both sides of the mergers and acquisitions side. I've been on the acquiring side more often and involved in doing due diligence and then acclimating new employees to the company, and then at one time on the acquired side. What was interesting about the M&T coming into the marketplace, they're still a Buffalo-based bank, but they were primarily at that time Buffalo, Rochester, Western New York, Syracuse, Albany, and they were in Manhattan a little bit. And I'm not going to pull any punches during this presentation. There's going to be some warts we'll talk about from the companies. One of the things they were talking about was how similar Western PA is to Western New York to South Central PA, and what we do for customers there, we can do here, products, pricing, fees, etc. Well, that was sorely missed because, number one, the market share that they had in Buffalo and Rochester and Syracuse and Albany was significantly higher meaning they had less competition, they could price better, and fees were higher. Number two, coming into South Central PA, the size of the demographics are much different. The largest town around here is Lancaster, and 50, 60,000 people. Buffalo, it's 250,000 people. Rochester, it's similar. So just the size of the population base allows you to do things differently. What that all meant then was a year after the merger, based on how we priced our deposits and charged fees with overdrafts and uncollected fees, especially on the business side, we saw a $200 million runoff of deposits out the door. And everybody was scratching their head, well, how could that be? Well, a lot had to do with a different marketplace. So Orrstown, it's a NASDAQ-traded company. Next year, we're celebrating our 100-year anniversary. Orrstown Bank is the wholly owned subsidiary of Orrstown Financial Services. We're from Hagerstown, Maryland, coming up the 81 corridor, the Harrisburg, Lancaster County markets, and then over into Berks County, the Wyomissing marketplace. We're trying to figure out what to do for next year for the 100th anniversary. A lot of good ideas, and I'll share one of them that popped up was we're talking about doing a pay it forward scenario and giving 100 people $1,000 and saying, okay, go do something good with that and then document it and then come back and tell your story. Not sure if that's going to happen or not, but that was one of the things that was kicked around. One of the things we're struggling with is we've had a lot of recent growth, is making sure our branding is accurate and correct, whether you're in Hagerstown or Carlisle or Chambersburg or Lancaster. And with, we're spending a lot of money investing in technology. However, our original logo was a horse and buggy, and it was based out of Orrstown, and it's supposedly a doctor's carriage that would make house calls back when this bank was started 100 years ago. And if you go by our branch that we have in Mechanicsburg off of Route 114 and 81, we have on the outside of the building a horse and buggy. Well, that really doesn't make you feel like that's a bank on the cutting edge of technology. So, we have things that we have to do to straighten our house out, but despite that, we're doing well. We're a commercial bank. We offer loans, deposits, both on the commercial side and the retail side, and cash management services, collection of funds and disbursement of funds. I'm in the commercial banking world, dealing with business owners. We have residential mortgage purchases, refis, and construction loans. And then our Orrstown Financial Advisors handles the investments, the wealth management, trust management, et cetera. So this is a snapshot. This is public information from the last 5 years of our year-end performance. A couple of highlights. So total asset growth of $1,178,000 to $1,560,000, and then the net loans from $652 million to a little over $1 billion in 2017. One of the things I'll talk about in a little bit is that this Orrstown went through issues with the economic recession in the 2011-2012 timeframe, and it severely impacted what the organization could do, and finally came out of it. In 13, 14, and then 15, got the green light from our regulators to move forward, to build new branches, et cetera. Deposits kept climbing. One of the numbers here for net income, for instance, you'll see that $6 million in 06 and then $8 million in 07. That $8 million was really 10.7 million. The recent tax reform law change that went into effect at the end of December for 2018. You'll see financial institutions were able to take a look at their investments they held, the tax-deferred investments, write them down, called mark-to-market, write them down and offset them against income in 2017 at a higher tax bracket. So it's basically like a paper loss to offset income in 2017. So that's what's reported. The $8 million. Really, what we made was $10.7 million. It was weird though when we reported our fourth quarter earnings and they said you basically made zero. We're like, what do you mean? We worked our butts off and had good performance. Well, it was because of this. A couple other key things. Net interest margin. That's one of the things that the banks are measured on. And that's the money you make on your loans versus the money you pay out on your deposits. So obviously the bigger the spread, the more money you make. In a rising rate environment, it's good for financial institutions because the banks are going to raise loan rates faster than they raise deposit rates. So we had a pickup this past year here of almost 18 basis points. Banks also look at efficiency ratios. So what does that mean? That is, for a dollar of revenue, how much does it cost to generate that dollar of revenue? So 5 years ago it was 83%, 83 cents in the dollar, 82 cents in 16, and 76 in 17. What was interesting, as I mentioned before, is the bank came out of the recession much later than some of the larger banks. We finally got clearance. We took a portfolio of loans and that were considered bad loans and sold them to other investors. And it cleaned up our balance sheet and allowed us to move forward with a much cleaner balance sheet and ready to roll. At that same time, I mentioned earlier about the market activity. You had First National Bank, FNB, buying Commerce Metro Bank, for those that are local. You had S&T Bank buying Integrity Bank. You had BB&T buying Susquehanna Bank, which also was still absorbing Greystone Bank. And then they also bought Nat Penn Bank. So you had a lot of influx of people. So Orrstown was now in the position, having received the money from the sale of those bad loans, and with an opportunity to bring a lot of folks in, did just that. And so we hired folks like myself on the commercial side, on the retail side, on the wealth management side, as well as on operationally. It was kind of like buying a bank without buying a bank. That's why you see performance was good in 16. Our efficiency ratio was still high because they had to pay for people that they didn't have to pay for in the past. And then it dropped in 17 to 76%, which means that we were actually doing what we were hired to do, which was bring in business. The second to last one, the non-interest income over operating revenue, is essentially, you hear about diversifying cash streams. The bank needs to figure out a way, well, what if the economy takes another nosedive and we can't write any loans? How are you going to make money? Well, you're looking at from the wealth management side as well as insurance and some other areas. So our goal is to increase that to about 40% at a minimum. And it also, investors look at banks that have those avenues for earning income outside of the loan-to-deposit spread as more favorable, so you get a higher stock price, stock appreciation in that regard. And then the last line, which is near and dear to banks, is loan-to-deposit ratio. So if you have all this growth in loans, how do you pay for them? Well, you pay for them with, the cheapest way to pay for them is with core deposits. So you're going out and getting business checking accounts and savings accounts and consumer deposit accounts. That's the cheapest way to pay for them. So if you have significant loan growth and you don't have anywhere the deposits to pay for them, you have to go out and pay higher premium, whether you're borrowing from the Federal Reserve or from other banks. If nothing else that you remember this in dealing with any financial institution, the 5 C's of credit. And that's our, we're in the risk management business. Character, capacity, capital, collateral, and conditions. So as we're looking at loan opportunities, and I'm on the commercial side, let's say I'm dealing with a doctor wanting to build a new building for his practice, or a warehouse for a company. We'll look at what business references do they have, what's their debt coverage ratio, which is really the inverse of debt to income ratio on the personal side. Do they have equity in the project? Do they have, what's the collateral they're pledging for it? What are the conditions? Did they do if this is more of a startup, have they done a SWOT analysis and in their business plan to identify the risks? You can have all those things and still not get a loan. And I give the example of what if you've had a history of performance, you have great references, you've got collateral, you've got equity. If you have all those things, but you're a typewriter repair company, well, there's not too many typewriters being purchased anymore. So you also have to look at what the future entails. It also doesn't mean that if you don't have any of those, you could have one thing. Let's say your cash collateral. You've got cash, you're going to pledge it for the loan. All right, well, that covers up a lot of scars. So this last point here, banks try to get to 0.5% or less in delinquency on a portfolio of loans. Just to put that in perspective, if I have a $20 million portfolio, all of $100,000 loans, for instance, we have to guess right 199 out of 200 times to get that 0.5%. So that's why it's critical that as we're going through and analyzing the risk factors, that we get them right. And if we don't get it right, then we have to have, how can we collect it? And that's where the collateral comes in. We also run into scenarios where, on the business side, that you get guarantors, the individuals that own the businesses guarantee the loans. And that's when you find out if a person has character. We've had scenarios where people will give their shirt off their back and their last dollar to make sure the bank is repaid. And we've had our workout folks that have lived through these have come back to us and said, listen, if you're ever going to make a new loan, deal with this guy because he did everything he said he was going to do to pay us back. Conversely, we've also had the other folks that have all the money in the world that to repay, and they won't do a thing to open up their wallet. And that's when trouble ensues and it really gets messy. But that all points to character is, are you dealing with the right people? So as I said, we're talk about the start of the century. That was right at the heels of the dot-com bubble. So when I was in banking in the 90s, I had folks that I talked to that were doing their daytime job, and then at lunchtime they were day trading, because you couldn't go wrong at that time. Whatever you put money into in the NASDAQ, if it had .com after it, it was going up. It was insane. The NASDAQ index went from 1,000 to over 5,000 in that 5-year period, peaking at 5,048 in March of 2000. As I put on here, it was 7,000 on Wednesday. Well, it's below that now, based on the past couple of days. But it had gone up that fast, and it's taken that long to go from 5,000 to 18 years to get to 7,000. Why? There's abundance of capital, overconfidence, pure speculation. If you remember the 5 C's of credit, they were pretty much thrown out the window. The valuations for these companies were based on projections that never materialized. In some cases, the product wasn't even put to market yet, but because you put it out there on an IPO, people were buying it, and it was a feeding frenzy. Then the next big thing to hit on the heels of that was 9/11. Back then, if you paid a check to someone for products or services, it was an actual hard check that got sent from your bank or from the provider of those services to the Federal Reserve, which went to the bank that they deposited, and then the funds flowed back around. The original check comes back to your bank. That was all manual. It was all transportation in trucks. Federal Reserve District in New York, the largest one. 9/11 happens. Checks are sitting in trucks and they can't get in the city. Checks that are in the city can't get out. So basically, money stopped flowing. Some of the outcomes from that that affected our world, the Patriot Act, the data mining between departments. Some departments had information on these terrorists, some had it on these. We finally started collaborating to to identify money laundering for terrorist activities. Cash became king because those flow of funds had basically stopped for a period of time. Cash was king. There was a real measure on putting in off-site and duplicative storage and systems. So for instance, for us, we had Buffalo, we had Baltimore, and then we had a west, like Arizona, I think. So you couldn't have any geographical, like a weather condition, a blizzard or a flood, affect all of those so that we could keep operating. And then Check 21 was instituted at that time, and that's where you get your checks get scanned through, and an electronic version of that check is now used as an original. You'll see that where in the stores where it runs through a little machine and scans the check. That's exactly what they're doing. What it did is it eliminated the float. So as I said before, when you paid a check and it went through the process, it went to the Fed, it went to the other bank, and the funds came back around, that took days or even weeks, especially if it was a California-based bank. And people would write a check today on funds that they would know they would get a deposit in next week to pay for down the road. Well, that's playing the float. That disappeared because now checks are processing much quicker in a day or 2 days, and in some cases it's same day. The Federal Reserve, based on what was happening with 9/11, kept dropping interest rates. So for the next 2 years, the rates kept dropping from 2001 through 2003, where the Fed funds rate dropped to a low of 1. There was rising home prices, which created this confidence again in housing prices, employment stability. Folks were leveraging up their assets. They're taking out a mortgage, taking out a home equity, much more confident. It was in certain areas, this got really insane with these rising home prices, which I'll talk about in a minute. I had a dentist client that was probably within 5 years of retirement. And at that time, from 02, 03, 04, he's looking to buy a house in Florida, and he would visit about every 3 months. Every time he visited, that same home went up in $50,000 increments. And it was almost a merry-go-round, when do you jump off? And he finally bit the bullet and bought, but it was insane. And we're back here in South Central PA going, we don't have that issue. We don't have, we're not getting the benefit of it, but we also didn't see the prices rise that fast. The Big Short. Anybody seen this movie? Yeah, a bunch of you. It talks about the movie. If you haven't, I would encourage you to do that. Well, you can argue whether it was a good indication of what took place in the economic recession. The housing bubble burst. I do know that it was a good enough presentation that my wife, who's a non-financial person, understood it, or she just liked Ryan Gosling and Brad Pitt, whichever the case. But it has to do with the collateralized debt obligations at that time as they are wrapped up, and I'll just try to explain it briefly because this is a whole semester topic. Basically, when you take out a mortgage to buy a house, the banks will then take a number of those, they'll sell them to investors who bundle them all together and then sell that investment to like pension funds and hedge funds. And along the way, there are various folks involved with these debt obligation managers. Rating agencies will rate that bundle of loans, and for instance, a prime bundle would be someone that had all the loans in there, have a good loan to value, they have good credit history, good repayments, they're all similar in size as far as the lot that the homes are on. Those are prime loans. You get the best rates because of all those things, so if you're a borrower, you get a better rate. Those are all prime loans. So these are all the folks involved in that process. It's a good thing. It allows the flow of funds to come back around, and people were able to keep lending again. The CDOs were started back in the 80s with Michael Milken, the former junk bond king who went to prison for his issues. But it was a security product that was they were able to use it again with other assets with predictable income streams. So that housing market boom that happened in '03 through '05, '06, they started using the CDO product to basically facilitate subprime mortgage loans, mortgage-backed securities. So what are they? Subprime loans. I mentioned before about prime loans, subprime meaning they're much more risky for various reasons. They were 100% mortgage loans, meaning the people put no money down to buy a house and finance it over 30, 40 years. Interest-only loans, where you're only paying interest, not paying any principal back until it balloons at some point down the road. 40-year amortizations. If you'll find now, there aren't any offered over 30 years for a house. They're offering 40. Why do you offer 40? Well, because the payments are so high in markets that in order for people to afford them, they offered 40-year loans at that time. SASI loans, SASI, stated assets, stated income. That means I go to you to take a loan application and you tell me I've got $500,000 in assets and I make $100,000 a year. That's it. And that's making loans off of that. The most interesting was they called them ninja loans. No income, no job, no assets, and when the loans went south, they disappeared like a ninja. But that's what was happening. And the markets, the coastal Florida, Vegas, LA, Southern California, these were a big chunk of the bankruptcies and the foreclosures were happening in these markets at such a high rate. The Big Short, the movie that talked about that, gave some examples of a bartender buying a second or third or fourth house on his income, but he was basing it on the value of the homes kept rising. I mentioned before about the dentist in Florida buying a house. Well, they were rising that fast, and when they got it to a point, they'd sell it and buy another one. And this just kept happening. But going back to the 5 C's of credit, they threw 3 of those out the window. So that CDO market that helps securitize and fund those loans went from $30 billion in '03. 3 years later, it went up tenfold to $225 billion. Interest rates kept rising. The economy's doing better. People that had those interest-only loans can't afford them. Unable to pay the debts, and that's what started the unraveling starting in '07. Developers. So now you're on the commercial side, and you have got all these lots to sell, and you are selling them at values that were going through the roof. People that bought them can't afford to repay, or they can't sell any new ones. This then happened on the commercial side too. A couple of key players in this. Washington Mutual, one of the largest, $300 billion absorbed by JP Morgan. Countrywide, they were one of the most aggressive in the subprime. I mean, they were expanding like nobody's business. They were the ones putting in the Starbucks in their branches before anybody else. They collapsed. What's worse, Countrywide at the same time, I'm painting a pretty picture of the banking industry, right? They're taking back properties, or maybe it's that second or third or fourth house that no one's living in that had been financed. You got to upkeep those homes. So you got to cut the lawn. You got to make sure the utilities are paid, the taxes are paid. Well, they were overcharging their customers to the tune of $100 million, and they had to pay that back to all these folks. An example they gave was they charged $300 to cut someone's lawn that lives in a subdivision that would normally cost $20. Bear Stearns was the first investment bank to collapse with their funds. A couple of things that they did, key things that they did wrong. When you take these portfolios of subprime loans, you then have to test how they would perform in extreme conditions. So what happens if rates go up 3% or 6%? What happens if people stop paying? There's 10% delinquency, there's 20% delinquency, there's 50% delinquency. They didn't do that. And because of that, they didn't have the liquidity to back it up when people came, hey, you need to pay these loans. And then they over-leveraged. They used their assets, bought more, and continued that process, and it was a giant snowball effect. What's worse is that unraveling of the housing industry affected everybody else. So it affected contractors, subcontractors, pavers, framers, electricians, HVAC, plumbing, landscapers. And if people aren't buying houses, it sure means they're also not buying cars. So if you heard about the cash for clunkers, that was a project put in place by the federal government to help the car industry, which basically tanked at that same time. And then not only do you have that, you have the suppliers of all the auto parts. So from Western PA through Indiana and Michigan, you have boatloads of employees of auto parts companies that are affected, and the companies that we did business with, machine shops, they were all affected by the auto industry, which was affected by the housing industry. I mean, it was widespread. You know, government stepped in and bought TARP money and invested in GMAC, GM, and Chrysler. AIG was also a company that essentially collapsed. They were one of the companies that insured all of this. Lehman Brothers, largest filing of bankruptcy, surpassing Enron and WorldCom. They said they were the largest victim of the subprime market. Well, victim in air quotes in the fact that they were the ones that bought these subprime companies, and they were one of the perpetrators of what was happening. So how do we get affected locally when we're not in Las Vegas, we're not in Florida, we're not involved in those hot markets? What was happening is, and the example I give is, we're invested in a project, $25 million project, and we lent $20 million. Our borrower puts in $5 million. And this is a project of, it could have been a residential lot development, it could have been a commercial strip center, it could have been a condo. They all are interchangeable at this point. And you get a feasibility study that then gives a value for the appraisal, and that appraisal is based on that feasibility study that says, based on these prices, you'll sell, for instance, 10 lots per month, 120 lots per year, and you'll be out of this loan in 5 years, 500 lot development. Well, what ends up happening is this hits, the recession hits, and instead of selling 10 lots per month, maybe you're selling 2 lots every 3 months. Well, this happens a couple quarters in a row. The banks are now calling in appraisers and saying, hey, you got to come in and reappraise this property because our collateral, we don't think it's worth, this project is not worth what you said it was worth. Well, they come in and they say, well, instead of a $25 million project, it's now worth 12. And the problem is the bank has $14 million lent out on that project. So now we go to our borrower and say, Mr. Business Person, you need to put in $5 million to get this loan down to $9 million to get it right sized, at least to an 80% level. In most cases, we were looking for something less than that. So they have to come up with $5 million. The problem is that you're dealing with experienced developers, experienced business people, which also means they have other projects going on at the same time. And on this project, we may have asked for 5. On another project, we may have asked for 7. It was painfully evident that they were out of cash. And that's where we got affected. We had instances where, and this is one of the things that we as an industry didn't do well, was that we may be looking at project A and saying, okay, this $25 million project, he's got $10 million in cash, everything works out fine, but we weren't underwriting project B that he was involved in, and project C that he was involved in, and maybe project D that he was involved in. And when you have cash calls on all of those, it wipes out everything. So it was a domino effect. And during this time, a lot of everybody was looking for higher returns, and shareholders wanted more value for their stock. You got to make a higher net income. So everybody's chasing larger dollars. So you have a number of banks that party up and they say, okay, 3 or 4 of us will get together on a larger deal. Diversify risk, we'll spread it out, but then it allows you to do more. And this was happening a lot. And that's where I mentioned at the beginning where Orrstown had a portfolio of toxic loans. This was one of the reasons. We were doing commercial real estate in areas that we shouldn't have, on projects we shouldn't have, because we weren't there to monitor it every day. At the time I was at FNB. FNB was a Western PA bank, but we also had operations in Florida. And $1 million project here was a $10 million project down there. And this is exactly what we saw. We saw high-rise condos, we saw real estate development, residential lots, strip centers, you name it. It headed south. The larger banks were affected earlier in the recession, and they cleaned out their closet and the skeletons. The smaller banks were probably slower to recognize that, and also having resources of folks that can just focus in on dealing with these issues. So, what was the outcome of this? Obviously a number of things. One is we just talked about the full underwriting of every project the borrower is involved in, whether we're lending into it or not. Making sure that if all of these things go south, that we have somebody with cash to back it up. We had a local guy. We had looked at doing a hotel for him off of 81, and he had cash collateral, or he had cash equity to put into the project. Everything seemed to be fine, but we just weren't comfortable that if something didn't go right, if he didn't hit his projections, that he would not be able to repay the $4 million loan. And sure enough, that's exactly what happened. And so the bank that had it had to foreclose, and it's now with another bank, and it's with another seller, or another owner. The government created the Consumer Financial Protection Bureau. This is helping the folks that were the ones buying these subprime mortgage loans. They're protecting them from unscrupulous salespeople, and there are in every industry, and we have our fair share of them. Interesting, Wells Fargo, just had their recent issues of selling products to people that they didn't know they were buying them, because they had a culture of sales, and quotas to meet, and you'll see where people were giving out credit cards and debit cards and savings accounts to folks that never even stepped foot in their bank, and that's where they just got fined hugely by the feds. My brother-in-law worked for them, and he goes, absolutely, that was what was happening, and I had to get out. And it's a shame, because it puts it's another black eye on an industry that's meant to help people. Regulatory scrutiny. Prior to the economic recession, if you were a state chartered bank, it was I would say a cakewalk when you're talking to the regulators. When they're coming in talking to you, asking you why you did this loan, and tell me what were the reasons, and you don't see any hiccups, and it was easy. The Fed's not so much. Well, now that's not the case for anybody. It's a you need to dot your I's and cross your T's. Documentation of customers. This will be starting May 1 of this year, and it seems insane, and I say the same thing, but so you're opening an account. If you're a new customer, yeah, you're going to have to provide all your documentation of who the borrower or who you are with the account, and if you have partners involved. But let's say you've been a lifelong customer, or your business has been a lifelong customer. You open a new account as an existing customer, we're still going to require documentation for all the people involved. It seems silly, but that's one of the things we have to deal with. And to make things more interesting, competitors in the marketplace, the crowdfunding sources, the online banking with Ally and SoFi are two examples. So first of all, so why do we do it? Why am I here? Why am I still in the industry? Number one, there's no greater joy than giving someone their first house. There's, or when you're giving someone a loan to expand their business on a project, and it takes off and it does, it's wildly successful. Those are truly, fun times. We're involved in the community. We're local. We try to give back both in time and resources, and you'll get back from what you give. And for instance, we were at an event last night where we were all those that had donated to a local private school were being honored. Well, while I was there, people were asking what I do and so forth, and I ended up walking out with 2 new customers just because of being there and talking to people. So, word to the wise is network, get involved in nonprofits, get involved in areas that have a, pull at your heartstrings. Any of those areas, those are the great reasons to do it. You'll get more out of it than you give. We're trying to leverage technology to attract and retain clients. I mentioned before that we're diversifying income streams, and then we're continuing to focus on our risk throughout the organization. It's been a wild ride in especially this last 10 years. They talk about the economic recovery. I'll be honest and tell you it didn't feel like a recovery till about 2013, 2012, even though technically we were out of the recession in 2009. So with that, say thank you, and I'll answer any questions you might have. Yes.
Mr. Wasson, how did you first enter the banking industry? Did you get an internship?
So I graduated in '90, and at that time, very few people were hiring. Banks were one of them. And it was interesting. I remember going into one of my interviews and said, well, I want to get into banking because I don't want to get into sales. Boy, I was wrong. It's all sales. But that was my mindset. Luckily, despite that, they still hired me. Yeah.
Have you ever dealt with a bank run?
I'm sorry?
Have you ever dealt with a bank run? Like during the 08 recession? Did your bank have
A run on deposits?
Yeah.
No. At that time, the feds actually increased insurance specifically to negate that. So luckily, no.
It's still at 250, isn't it?
Yeah, but there was a point where it was higher on the commercial, and then it came back.
Okay.
Funny story. I'm sorry. Go ahead.
I'm just curious to know, do you happen to know why a lot of banks today, in order to get a loan for a house, they require you to get loans on other things? Just to me, it kind of seems like counteractive. In order to get in debt, you get more debt.
I'm not sure the circumstances on that, but
Well, I've heard some banks, for example, if you want to buy a house, they want to make sure that you have to buy a car or something like that, in order that way you have enough credit or something.
well, you need to have credit history, but I don't know that lending for other things makes that happen. I do know that, for instance, when you buy a house and you don't have 20% down, there's what's called private mortgage insurance that you have to get, and what that means is that if they had to foreclose on it, that insurance would cover the top 25% of the loan, so that the lender could recoup their money. To avoid that insurance premium, people may take out a 10% home equity at the same time and do a 90% loan, so an 80 and a 10, and then you only need 10%. But you need good credit for that because now you have 2 payments instead of just the one. Yeah.
What skills would be important in the banking industry, if you wanted to get involved?
Good.
Like Excel?
Mhm.
Or
Good question. Sure. So you need to. We're heavy Microsoft. So Word, Excel, PowerPoint. Although that I don't use this very often. Communication skills, face to face, over the phone. One of the things about this generation I see with my kids is they're so used to, hey, I need you to go call this person, and they're texting them. So, well, what did they say? Well, they didn't respond back. Why? You got to talk to them. So talking to people face to face is huge. You know, common sense, showing up, being consistent. You know, that's one of the things that will help you anywhere is, you know, consistency. Are you showing up for work to do, you know, what you need to do? Unless you're hungover from the Eagles parade yesterday, then yeah.
What do you think is going to happen to banking jobs maybe like 10, 15 years from now? Are they going to rise or fall? Or
Good question. You know, with the advent of technology, you're seeing a shift, and I don't know if it's necessarily a decrease in employees, but you're seeing a shift in employees from less tellers to more concierge type positions. We're still going to have our fair share of backroom and operational because of the regulatory constraints that we're all placed under to fill out the reporting requirements. But more concierge focused, more private banking type focused, and they could be call centers or they could be in-store, in-branch, but definitely a shift. I mean, there was a time when the branches that we closed in downtown Harrisburg that had been there for years. When you walked in, it was donated to an art association now. There are footprints in the granite in front of every teller station because people stood in line for so long, over so many years, that when the sun shined down, you could see these footprints in the granite. You know, you're not going to see that anymore. Yeah.
Has Orrstown Bank been affected by, like, say, the Dodd-Frank Act or increased regulation? Like, how has that affected Orrstown Bank? And do you see that as a good thing or a bad thing?
I think, personally, I think the regulatory reform's got to swing back to the middle. It's gotten so far to the one side, it just needs to come back to allow us to do our job, still do it the right way, still follow the 5 C's of credit we talked about, but it is overly burdensome, and that needs to come back. I mean, every bank's affected. The problem is with smaller organizations, you're still following the same rules as the larger ones, but you have less bodies to do it with. And so therefore, hiring more people just puts a crush on efficiency ratios and able to generate a dollar. So when you have backroom folks that you have to pay to do what is required, it puts a strain on income. Yeah.
Since the Dow dropped, do you see in the future effects of that for the banking industry?
I'm not going to speculate on the stock market. It's not what I do. I'll say that when people ask us, it's you're in it for the long term. If you're not, then you better be an expert on and that sort of thing. Although I say that, and I have in-laws who are just recently retired, and she's now watching her IRA 4 times a day. I'm going, for your stress level, you got to stop doing that. You didn't get here in one day. It's not going to go away in one day. So it's a long-term thing.
Okay, any other questions? Any other questions? No?
Thank you.